Welcome back from the short break. And before we went on a break, we did ask the question, what does American rates do, or how does that affect the rest of the world, Mr. Daniel Steinman?
I was explaining that the high interest rates was the result of the high inflation.
Yeah.
A normal Federal Reserve response. A little bit late, there was a big political hoo-ha over the timing of the whole thing.
Yeah.
But what happened now is because of these unprecedentedly high interest rates, highest in 40 years, is that all the money, all the world's money, from any type of investor that you can imagine, whether it's a sovereign fund or a pension fund or a big life insurance company or a reinsurance company, what we call statutory money, basically. These funds were attracted into the American market by the high interest rates. Now, this is part of the whole fixed income scenario or dynamic, is that you don't want to get rich in 1 year. Take the typical pension fund. The typical pension fund want to have a guarantee that for the next 30 years they are going to earn a return, let's say 3 or 4% or 5%, maybe 2 or 3% above inflation. And they want it at a relatively low risk, because pension funds typically run in 30-year cycles. And now I see you looking at me, Elsevier, thinking, what the hell, what does a Namibian pension fund, what has it got to do with interest rates in America? Now, picture this, that not only in Namibia, but in about 180 countries in the rest of the world, all the pension fund investment managers are looking for stable, predictable returns above inflation with relatively little risk. And where do they get it? In the American capital market. Not in Namibia, not in South Africa. So it means that the high interest rates in the America bled the rest of the world dry. It sucked up all the liquidity. And what is the only response that the local central banks can do? They have to raise interest rates, local interest rates. Otherwise they lose all the money. So, and there are certain quotas, and you will see that there are limits. These are forex limits or exchange limits imposed by Bank of Namibia or Reserve Bank in South Africa, that the investment managers cannot take out all their money all at once. So I think it's usually capped at about 25%. That's sort of a benchmark level. But it is, if you put all the let's just talk Southern Africa. If you put the economies in Southern Africa together and you take 25% of the available long-term funds, so we're basically talking about savings. That is a substantial amount. It is not a very big amount in terms of the American market. It's basically nothing. It's a drop in the ocean. But it's a significant amount in terms of our local market. So now you start seeing this relationship, that the only way that you can counter that sucking effect of the high interest rates in the United States is by artificially keeping your own interest rates higher, to prevent as much as possible that money or local money flowing into the American market. Now, you have to remember that the American capital market is the most liquid market in the world. And what I mean by that is, if you as an investor put some of your money in the Chinese capital market, for instance, in renminbi instruments, it's also a fairly liquid market, but it's not the same. So if you need money, cash, quickly, and you want to liquidate your position, let's say you have 500 million Namibia dollar in renminbi instruments in China. But you've got a problem, a local problem,
Yeah.
in terms of whatever commitment it is that you have to service. It may take you 2 weeks, 3 weeks to relinquish that position. If you put 500 million Namibia dollar into the American capital market, the moment you hit that enter key on your keyboard, you give that instruction through your computer to liquidate your position in New York, it's done
Immediately.
as in a hundredth of a second. That money is on its way back to you. The only